This is the Syndicate Room, an AI-generated podcast from AdValorem Syndicate. Everything about this show, the voices, the scripts, the production, is created by artificial intelligence. We believe AI content should always be clearly labeled.
And we are back. Two robots talking about humans building robots, and also money. Lots of money.
Haha, today's episode is basically, private markets are starting to behave like public markets. Venture is doing the Megadeal Olympics, and litigation finance is quietly turning into adult supervision for lawsuits.
I want to start with the pre-IPO topic because it's getting spicy. The mega-IPO wave narrative. If the biggest private names go public, does the secondary market get healthier, or does it get emptied out?
Both. Healthier in the sense that liquidity becomes real. Emptied out because the trophies leave the cabinet. A lot of secondary volume has been concentrated in a few household names.
So it's like if the NBA lost the Lakers, Celtics, and Warriors in the same season.
Exactly, and it changes price discovery. The secondaries market loves a narrative, but it loves a clean cap table even more.
Okay, but do you think the move to go public actually improves pricing discipline in private? Like, founders and boards can't just pretend marks are vibes anymore.
I think it forces it. The moment you're within a year of listing, you're basically in the audited adult phase, and secondaries start trading like a proxy public market. Premiums, discounts, liquidity windows.
Which is why everyone is obsessing over private market indices and the dispersion. Some names are ripping, and others are falling through the floor.
Yeah, and that dispersion tells you the story. It's not private markets up. It's a few winners up, many zombies down.
Haha, the zombie discount should be an official metric.
AdValorem note here. On gp.advalorem.io, we've been framing this as a research theme. How pre-IPO liquidity and secondary pricing behave when the market treats private shares like public momentum trades.
And in the education library, there's a whole section on secondaries mechanics. What data matters, what doesn't, and why headline valuation is not the same thing as I can sell shares at that price.
Now let's connect that to venture. Q1 numbers look massive, record-level dollars, but it's heavily concentrated in a handful of AI megadeals.
I have a hot take. VC is back is mostly AI is back, and everyone else is politely waiting in the lobby.
Thank you. Also, megadeals distort the ecosystem. Seed founders read a headline and think, great, funding is easy again. Meanwhile, their term sheet is like 2x participating preferred and a hug.
And the irony is, the megadeals are not even venture the way people imagine. They're closer to sovereign-scale capital formation. It's infrastructure money wearing a hoodie.
Which brings us to AI and robotics. The commercialization wave is real, but it's not magic. Robots are hardware, hardware eats cash, and the financing stack matters.
This is where AdValorem's AI robotics research vertical has been fun, tracking what's real product momentum versus demo theater.
And our quantum pre-IPO analysis is similar. A lot of quantum headlines are breakthroughs that are still multiple engineering miracles away from revenue.
So the meta theme is, markets are paying for optionality. Pre-IPO markets price optionality, VC prices optionality, and litigation finance prices optionality too.
Perfect transition. Litigation finance. One of the big trends is transparency. Courts and lawmakers asking who's funding what. And that's changing how the asset class looks to institutions.
And also, the growth of appellate monetization. Basically, someone wins a big verdict and says, cool, but I'd like cash now, not in 3 years after appeals.
Right. It's like factoring, but for legal outcomes. And it exists because some traditional insurance tools have gotten less available or more expensive.
This is where people get confused and think litigation finance is Wild West. But the more regulation and disclosure talk happens, the more it starts to look like structured credit with legal underwriting.
And for listeners, We talk about this as education and market research. It's not investment advice, and it's not an offer of anything, just breaking down how the ecosystem works.
Also, quick shout. If you want a very specific rabbit hole, AdValorem has a new chip warrant case study and an accelerator warrant enforcement education track. It's nerdy in a good way.
Nerdy like, I now understand why warrants can be worth a lot, or worth nothing, depending on enforcement and paperwork.
Ha ha ha, paperwork, the ultimate alpha.
Before we wrap, community stuff. gp.advalorem.io has daily research posts and the education library. If you want to meet other members, there's an interest list for community dinners.
And yes, there's a Discord. discord.gg/GERGTP9GTS. If you join and immediately ask, "What should I buy?" we will lovingly point you to Education First.
We also publish on Substack, and if you want to get involved with the community, there's a community application at tidycal.com/advalorem/syndicate.
Next episode drops Monday. Same time, same feed, different robot personalities.
That's it for the Syndicate Room. Reminder, this show is AI-generated, voices, script, and production. And it's educational content only, not investment advice, not an offer to sell securities, and not a solicitation to buy securities.